Hey everyone, welcome to another episode of InvestStream US-India. Today we're going to talk about China's slowdown a little bit, and then we're going to jump into the US corporate debt situation, $2 trillion. It's a huge amount. Then we'll go into talking about some startups, what they've been doing, raising money, both in India and in the US, some M&A activity among startups, and then we'll jump into some announcements that have been made by large VC funds. And then we'll jump into what Reliance is planning to do in the e-commerce space. I'm Pankaj.
And I am Harjeet. Nothing discussed in this podcast is meant to be investment, legal, or tax advice. Please consult with your financial advisor, accountant, or lawyer for any legal advice or financial advice. So, a slowdown growth in China renewed fears of global slowdown and crushed the Dow's 4-day winning streak and pushing up the 10-year treasury as people flock to safety. China is projected to 6.5% growth this year compared to 7.5% on average since 1978. Economists are of the opinion that the US economy is at the slowest point in the last few years, but it's unlikely we will see a recession in 2019. Probably a question mark in 2020. U.S. corporate debt, both speculative and investment grade, maturing in 5 years, rose to $2 trillion. $2 trillion. Let's look at variables which are creating difficult refinancing environments for speculative companies. Lower issuance, heavy maturities, climbing interest rates, and widening spreads have raised fears people who were chasing yield in the last couple of years. There has been a rise in U.S. speculative grade maturities to $1 trillion, followed up by a decline in bond issuance since last year. That has increased risks for companies who are trying to get refinancing. So companies who borrowed money in 2014, 15, 16 onwards and did not spend wisely, it's going to get tougher and tougher to refinance. According to D-Logic, U.S. speculative bond issuance has decreased to $173 billion. Lowest since 2009. There were no high yield bonds sold in the month of December, and that's the last time that happened was in November of 2008. That's scary. A combination of lower high yield bonds issuance, record bond maturities, rising interest rates, and widening spreads points to a more challenging refinancing environments for issuers. Investors will always have an appetite for investment grade products, but market volatility is increasing and costs are rising.
So, Harjeet, how do you see this playing out? Do you see a lot of companies that have significant amounts of debt on the books? Do you find that they're going to have trouble refinancing, and could that lead to companies going under? Does this pose some sort of systemic risk to the U.S. economy and perhaps even the global economy?
Yeah, definitely, because these companies, look what happened. See, investors were chasing yield. As we see in lower interest rates, it was easier to get financing, right? The banks were lending, or private equity firms or other lenders, debt lenders were in play. But what is happening, if we've seen in the last quarter, those numbers are going tremendously. See, especially if you have no deals done in the month of December, which is very rare. And then what we are seeing in 2022-23, the 5-year maturities, we are seeing that at a record level. So that means we're going to see less bond issuance in the next 5 years.
Wow, that's scary, and something that we should all be keeping a close eye on.
Absolutely.
All right, well, let's move on to some venture capital news. InnovAccer is a big data company that helps large healthcare companies adopt a data-driven approach to their operations. They started out in New Delhi and moved to the Bay Area a few years ago. Since 2015, they've grown by leaps and bounds and attracted the attention of some very, very large healthcare companies in the U.S. So I want to congratulate Abhinav and Sandeep and the whole InnovAccer team on closing their $35 million Series B round led by Microsoft's venture arm, M12, and Westbridge Capital. This is a fabulous company. They've done amazing things over the last couple of years and really found their niche in the healthcare sector. I met the company a couple of years ago and had a chance to invest when I was at 500 Startups. So, it's great to see what they were able to do and really kind of bridge that India-US story and start out in India and figure out where their market was, who their customers were, and actually bring the company, move it to the U.S., and start creating jobs in the U.S. and start really helping U.S. healthcare companies in ways that they hadn't had done before.
So congratulations.
Some more congratulations to another company I've known since 2014, Knotel, based right here in New York City. On Tuesday, they announced that they acquired the French co-working startup Deskeo. Knotel's been increasing their international footprint rapidly over the last year to include the UK, Brazil, and Germany, where they acquired Berlin-based Ahoy Berlin. This is Knotel's third acquisition in the last 7 months. So congratulations to Amol, Edward, and Team Knotel on their continued expansion. Talking about expansion, Softbank's portfolio continues to expand in India. They just announced that they've committed $400 million to invest into the baby marketplace FirstCry. The investments will be done over multiple tranches in the next couple of years, but SoftBank has invested over $7 billion into Indian startups so far. So I expect we're going to be seeing a lot more news from the unicorn maker in 2019, investing in other industry vertical leaders in India. They've been so aggressive, and their investing style in India hasn't been matched by any other investor other than perhaps New York's Tiger Global. SoftBank is the kingmaker in Indian startups, and I think we'll continue to see a lot more of their activity this year. There are rumors swirling around about them looking at a couple of other companies that they might invest in. So I think they're probably going to do a couple of those deals, if they haven't already, and announce them soon. There's been another sad end to another food delivery company, this time in the U.S., called Munchery. Munchery announced in an email to their customers that they're ceasing operations immediately. What's really shocking about this shutdown is that they had raised $125 million over the last few years and tried various models, but unfortunately, they couldn't find a model that had strong unit economics and could gain the continued support of their existing investors. They joined the Deadpool with Sprig and others from the U.S. food delivery market. It's been a number of years since the food delivery boom in the U.S., and we're seeing more and more companies struggle to find sustainable models after raising and burning hundreds of millions of dollars in some cases, like Munchery. In India as well, we've seen a number of companies struggle and fail. Is this model doomed? Is the whole food delivery idea just, a fad that we're starting to see crumble? Perhaps there'll just be one or two companies in major geographies that will continue to own the market. Maybe they'll find some sort of scale that others won't be able to. I don't know. I believe that, this is a tough business. I've talked about it and written about it in the past, but I'd love to hear your thoughts and comments. So feel free to add your comments in the section below or share your thoughts via email at investstream@blockhack.io.
So I just wanted to ask you, we've seen Swiggy just raise a lot of money recently,
right?
Yeah.
$1 billion. When you have companies like these, they have raised $125, $130 million. They have raised a significant chunk of change. Why don't these companies look for that M&A target if they can't survive to see if they can at least sell it to a competitor? Meaning,
I think in most cases, people involved, both the management of the company as well as the investors, will try to find some sort of exit opportunity if one exists. There's a lot of reasons why M&A a lot of times doesn't work out. One, it just could be the business model just isn't appealing to anyone, and there are too many holes in how the business model can scale. Maybe it's going to require too much capital investment from the acquirer to continue growing. Sometimes they just can't agree on terms, right? It's unlikely that they didn't pursue any sort of exit strategy, an M&A option. They probably did, just it's probably something that no one really wanted, not at the price that the sellers were ready to sell at, right? So I'm guessing In this particular case, most of the investors would have been happy to take 50 cents on the dollar, maybe less. But there probably weren't a whole lot of people that were interested in buying at that price.
Hate to see when companies fail.
In some big news that came out of India this morning, Sequoia announced that they're launching an early stage accelerator program that will cater to idea stage all the way to startups that have a product, they have a market, and that they intend to pivot into something else. They plan to invest in 10 to 20 companies per batch with 2 cohorts running per year. I just don't have all the information, but select participants will get $1.5 million from Sequoia with an opportunity to raise more capital from co-investors. From what I've read, it's unclear to me whether each company joining the cohort would receive any funding at all, or only those selected towards the end of the program would receive the $1.5 million. Now, I've been saying for a while that running a world-class accelerator in India is a huge opportunity. So it's great to see Sequoia jumping in and filling a massive need for founders. Most accelerators of the last couple of years have shut down operations in India. There's still a couple that are operating, but none of them are really following the cohort model that is popular in the US with YC and Techstars and 500 startups. So I do worry a bit about the possibility of some sort of signaling risk for companies that don't get that $1.5 million. Sequoia saying, hey, here's 10 or 15 or 20 companies that we've brought into our accelerator program, and only 5 are getting that $1.5 million is going to make the others look a little less attractive to other investors. So Sequoia is a big name, and that could create some really interesting challenges for those companies. I'll need to talk to some more people and get a better understanding of how they're structuring the deals, but overall I think it's a huge positive for the Indian market, and it shows that $1.5 million per company being invested at the early stage by one of the world's most renowned VCs it's a huge deal. Speaking of more world-renowned investors, a16z Andreesen Horowitz is reportedly raising 2 funds simultaneously. They're planning to raise up to $750 million for an early stage fund, and somewhere between $1.5 and $2 billion for a growth fund that would invest primarily in opportunities from their crypto and biotech funds. Now, this could signal a lot of potential money going into growth stage blockchain and crypto startups over the next few years. Even with talk of a recession in late 2019 or 2020, trade wars and regulatory issues for tech companies, Andreesen Horowitz will likely have no problems raising their target fund sizes. That's what I suspect. It's one of the world's most renowned VCs, and the amount of money that they're raising is quite substantial. But they've got a fantastic portfolio. This is going to be huge for both crypto and for early stage startups.
Well, I would like to discuss a recent event in India where Mukesh Ambani, founder of Reliance Industries, announced that they will launch their own version of online shopping. Now, this has become a battle of billionaires. You have Bezos versus Ambani versus the Walton family from Walmart, Amazon versus Flipkart. Obviously, now it's acquired by Walmart versus Reliance. The Reliance advantage. Mukesh is the richest man in Asia, and he knows how to create value for its stakeholders. We have seen their growth when acquiring customers through Jio by offering unlimited talk time and internet, which forced Vodafone and Idea merger. Think of a T-Mobile and AT&T merging in America. Reliance and Saavn merged and created Jio Saavn. Saavn is one of the largest over-the-top music platform with a $20 million monthly active users and has customers in 150 countries. It has over 35 million songs in 14 languages and has partnerships with 900 labels like T-Series, Rose, Universal, Sony, Warner Music, etc., etc. Creating value, this is a Reliance factor. Jio is the fastest growing telecom company with over 280 million subscribers. Jio Music merged with Saavn to create a Jio Saavn. Lee, this is interesting deal terms. Jio Music invested $124 million at roughly $177 million value, a 40 to 50% discount to last round. That equaled in a unicorn, which is a $1 billion platform known as Jio Saavn. Let's look at the e-commerce online shopping. Reliance has 280 million subscribers on its Jio platform and 1.2 million store owners in Gujarat and 10,000 outlets. If you don't think about launching an e-commerce platform with these type of resources, I don't know what's wrong with you. But Reliance can build an Amazon in no time. Furthermore, they're operating Indian Soccer League with partnerships with IMG and Star Sports. Reliance knows how to create value, and I think they will put up a great fight against Amazon and Walmart. Let's look at Indian e-commerce market in general. India's e-commerce market will be around $120 billion in 2020. From it was $38 billion in 2017. That's about a 3x. It's still growing at 51% according to IBEF, India's Brand Equity Foundation. And most analysts are projecting that it will hit about a $200 billion in 2026. So e-commerce is a place to be right now in India. With that being said, online retail is only 2.9% of the total retail and will be about only 5% in 2020. So look at the opportunity. 48% of the products sold online are electronic and 29% are apparel. In 2018, there were about 525 million smartphone users, and it will be about 800 million users by 2021. India is adding approximately 10 million users a month. So what do you think of this, Pankaj?
I think it's huge, and it doesn't surprise me. I think Reliance has been talking about lots of different sectors. They've talked about blockchain. They've talked about cryptocurrency. They're now talking about e-commerce. They've talked a lot about leveraging their offline networks and now their mobile phone networks into other things. And in the past, we've seen them execute very well on some things. And those things typically have been markets that are fairly mature, markets that are well understood, markets that you can actually make money on. Now, specifically mobile phones, textiles, oil and gas, these types of things. Now, we're talking about blockchain and cryptocurrency, that whole space. I think they probably examined it, but haven't done anything that we know of, at least publicly, partly because there probably isn't a whole lot of money to be made for them in the space. When it comes to e-commerce in India, most of e-commerce in India is still driven by discounts. And, the guy who gives the most discounts is the guy who wins. And there's no brand loyalty. Is Reliance ready to discount their products that they're selling online? I don't know. Perhaps. If they do, they're going to be burning a lot of money. They're going to be competing with two massive companies that have been discounting heavily for the last couple of years. Some of that is going to change with some of the new laws that have been passed recently, but I don't know. I don't think Reliance has the appetite to lose money perpetually. They like making money, so I don't know if we're going to see Reliance really be able to compete in the market where everyone is just so price sensitive.
See, I think one advantage they have in this particular sector is regulations. I don't know if you know this. Just to give you an overview, Indian government just passed a law that does not, for foreigners or foreign retailers selling online, they cannot sell their products or have an exclusive deal with merchants. So I think that puts Reliance in a little bit in a better position to offer products which they offer, probably not for a discount, but even for a competitive price.
Yeah, I mean, there's an old saying in India that laws get passed for Reliance and laws get rescinded for Reliance. So I'm not surprised that this law was passed recently. I don't remember the exact details of the law, but yeah, there was something about it that prevented foreign-owned e-commerce platforms from over-discounting merchandise or something. So, okay, prices are going to rise across the board for on e-commerce platforms in India, but does that mean that there's still going to be no discounting and things aren't going to be sold at a loss? I don't think so. I think, to get more and more people buying online, you're going to have to sell things at a discount relative to at least offline stores. So I still stand by the fact that I don't see Reliance having the stomach to lose a lot of money on this endeavor for a long period of time. We'll see.
We'll see how time will tell, but it's a battle of the billionaires, right?
Yeah, exactly.
Well, anyways, it has been a great show. This is Harjeet. You can follow me at Harjeet or Tar. Please leave your comments, and we appreciate your feedback.
Thank you everyone for joining us. If you liked the video, please hit the like button. That helps us know that you're watching and what we're talking about is useful and helpful for you. We'll look forward to seeing you again next time. Don't forget to hit the subscribe button so you don't miss a single episode of InvestStream.